morning. This is Business Morning, and thank you for joining us. I'm Chimize Obi Iwag. We'll begin with global oil market as prices fell around 2% this morning as a spike in new coronavirus cases in China and the United States renewed fears that people would stay home, stalling a recovery in fuel demand even as lockdowns ease. U.S. West Texas Intermediate crude futures dropped 2.1% to $37.16 a barrel, adding to a loss of 42 cents on Wednesday. Brent crude futures fell 1.5% to $40.10 a barrel. The benchmark contract declined 25 cents on Wednesday. Worries about fuel demand rose after a surge in coronavirus cases led Beijing to cancel flights and shut schools, and several U.S. states, including Texas, Florida, and California, reported sharp increases in new cases. A rise in U.S. crude stockpiles to a record high for a second week in a row also weighed on sentiment, even though U.S. government data showed inventories of gasoline and distillate, which include diesel and heating oil, fell. Analysts say while prices dipped, they are likely to remain in the $35 to $40 band. They have been trading in so far in June with the Organization of the Petroleum Exporting Countries and its allies, a grouping called OPEC Plus, mostly sticking to promised supply cuts. U.S. shale producers holding back output and fuel demand gradually improving. However, OPEC warned in a monthly report the market will remain in surplus in the second half of 2020, even as demand improves, as it now expects supply from outside the group to be about 300,000 barrels per day, higher than earlier thought. Well, the National Bureau of Statistics yesterday released the inflation figures for May 2020, and the figures showed 6 basis points increase to 12.40% year-on-year from 12.34% in April. The Consumer Price Index is now at 25-month high, with more macroeconomic pressures expected in June. How will upward movement in inflation rate impact the financial markets and shape investment decisions? The head of portfolio management at Commercial Partners, Victor Aluyi, will give us some of the answers. Good morning, Victor. Thank you for joining us.
Good morning. Thank you for having me.
Now, May 2020 Consumer Price Index rose by 12.40% year-on-year from 12.34% in April. From the market's point of view, was that in line with expectations?
Well, pretty much in line with expectations. Over the last couple of months, as a result of certain policy initiatives like the border closure and obviously the expected impact from the restriction of movement and essentially the shutting down of the economy on the back of the COVID-19 crisis, the expectation is that the headline number will continue to rise in the coming months. Like you mentioned, this is the highest we're seeing in a little over 2 years. And we expect that uptick is certainly going to continue for the next couple of months.
Now, for some analysts, what is most worrisome is the month-on-month inflation, which keep trending up. Is that a concern to you too?
Well, so if you look at the number, the headline number that we've seen for May, it's basically been driven by both food and core inflation. But again, if you sort of dimension into the numbers, you will see that this increase has been largely anchored by core inflation. And interestingly, for the second consecutive month, core inflation expanded by about 14 basis points, year on year. And if you look at the various sub-indices within the core index, you are seeing expansions of about 39 basis points in health. You are seeing expansions of about 31 basis points in stuff like transport. And this is largely reflective of, the pass-through impact of, the currency weakness. You are seeing the pass-through impact of the, if you will, shutdown of the economy that has created significant supply-side bottlenecks, that continue to put an upward pressure on that core number. If you look at on the food side of things, the increase in food inflation year on year was just 1 basis point. Again, if you dimension that into the various components of food, you will see that there was a decline in farm produce. However, the increase in processed foods was very strong, and that essentially offset the decline that we saw in farm produce. And that, again, is reflective, of weakening currency situation, the currency challenge, and also the movement restrictions that we have seen over the last couple of months. Recall that, the border closure had started towards the end of last year and had essentially continued. And then add on top of that, the closures or on interstate movement that we've also had with the COVID-19 situation. So all of that has essentially acted to put pressure on that inflation number. And we're likely to see that pressure going forward.
Now, looking at the financial markets, what role will the latest inflation data have on yields and interest rates?
Well, truth of the matter is that the inflation number doesn't really anchor much right now with the financial markets. There are other variables that investors are really strongly looking at, like the currency situation. We've had this rising inflation for months now. Like we mentioned, this is the highest we've seen in 25 months. So I think markets is not overly focused on that now. It's not significantly impacting or driving, decision by participants at this time. I think that participants are focused on factors such as, the exchange rate situation, and also looking at how they can, rebalance their portfolios for optimum returns. So we've had these sort of negative real returns, if you will, over the last couple of months. And then, those yields, particularly in the fixed income market, even, keep dropping. So that there are other factors, particularly the sort of liquidity that we're also seeing in the system that continues to impact more significantly on the market than, what this inflation number will do, at least in the medium term.
The DMO has so far raised about 40% of its net domestic borrowing target. That's about 2.2 trillion naira year for the year, leaving about 1.3 trillion naira for its issuance program in 2020. With the rise in inflation, how much room does the debt market have for an upward repricing in bond yields for the later part of the year?
I think if you look at the macro data and look at the macro situation, some you would argue that these yields are not supposed to be where they are, and as a matter of fact, should probably be heading in an opposite direction. But again, like I mentioned earlier, you have quite a sizable amount of liquidity, that keeps coming into the system between now and the end of the year. You have anywhere around about 4 trillion worth of liquidity that will come in, and this liquidity needs to find a home. It needs to find outlets. So all of this liquidity essentially keeps putting pressure on, the yields. So if you take the Sukuk, offering, for instance, the federal government wanted to raise about 150. They got a subscription over 600 billion. So again, that is reflective of the sort of liquidity that's in the system, and the fact that this liquidity will continue to act to put a downward pressure, on yield. So as far as headroom is concerned for the DMO, with the amount of liquidity that we have in the system and that we have coming through, they'll certainly be able to raise, what they want to raise. As to whether these yields would reverse, maybe in the medium to long term, there is a possibility that will happen. But for as long as we have this, amount of liquidity coming through, it is very likely that they will keep, a cap of those yields.
Equities market yesterday defied the rise in inflation figures to close uptake. How will equity investors now further price the inflation data into their decisions, perhaps?
Well, I think so. For the equities market, what you basically saw yesterday was, the market snapping a 4-day losing streak. Market had lost about 1.6% over the last 4 sessions, and it essentially sort of pulled through yesterday, just gained about 17 basis points. Before the losing streak commenced, we had seen the market sort of run up a little bit. So I would say that we're seeing some sort of profit-taking consolidation, if you will, going on in that market. And with 4 sessions of losses consecutively, broader market shedding about 1.6%, you're likely to see some bargain hunting come through into the market. As for the inflation number, again, I would say that it doesn't significantly anchor or drive major sentiment at this time. I think for equity investors, factors like, the quality of the earnings, factors like happenings or developments around the price of crude oil, and, particular specific developments around the various companies would, I think, supersede, driving sentiments as opposed to what that inflation number will do. So I think that what you're likely going to see is some consolidation from here on, because from the run that we had seen over the last couple of days, there's been some attractive entry points for some stocks. So you would obviously see bargain hunting setting in.
Now, yeah, but now lately the consumer goods sector hasn't really performed any better. Its losses have worsened to about 25.47%, although the sector was up yesterday. Now, how do you square up the impacts of the 24-month high inflation rate and, of course, the poor purchasing power of Nigerians for that?
Well, so if I think the issue, one of the biggest issues again we have with inflation is the supply side bottleneck. So it's not so much of a demand issue here in Nigeria. It's more around the inability of supply to meet up with that demand. So that typically then pushes up the prices that we pay for goods and services. So I think it's more of a supply side issue. So with the lockdowns and all of that, in spite of the reduction in purchasing power, you will see that there will be an uptick in inflation. So for the consumer goods companies, I think they would just largely be reflective of what's going on in the economy. Like you mentioned, consumers have been challenged for a while, and that challenge I think has been further exacerbated by recent happenings. The impact of which will probably stay with us for the better part of this year, probably into some part of next year. So from that perspective, the consumer guys would remain significantly challenged. So their performance is clearly reflective of investor sentiment of what's going on now with those companies and what is likely to happen at least in the medium term.
Now, the Economic Sustainability Committee on COVID-19 in a recent report recommended that a unified exchange rate will increase FAC disbursement in naira terms, among other recommendations. What are your thoughts on these vis-a-vis the current exchange rate situation and, again, the inflation trajectory?
I think as far as exchange rate goes, it becomes a bit tricky and sort of dicey because, again, the ammunition with which the Apex Bank will continue to, sustain the arrangements that we have on ground now, continues to be challenged, particularly by, crude prices. Again, the question is, do you really want to create a situation where you unify it completely and then you allow the currency or the forces of demand and supply to determine what happens in the market? There could be a steep price to pay there. So it's not an easy task really for the Apex Bank to juggle that and be able to clearly determine what it should do. But I think that a unification would certainly be a step in the right direction. We've seen some moves by the Apex Bank. We saw some moves in March and also in April, basically, trying to align, if you will, the various rates in the market. But I think it really remains to be seen how that will pan out. I think the Apex Bank will also continue to monitor the situation, particularly with respect to our external reserves, our external position as well, to ensure that the economy is protected from any further shocks that may arise, from the COVID-19 situation.
All right, let me take you back again to what you talked about, the components, all the components of the CPI basket, which, of course, also increased on a month-on-month basis with the highest jump observed on the food and non-alcoholic beverage. But when you consider the forces and demand and supply, how did the lower consumer purchasing power and the poor standard of living impact these figures?
Well, so, I think we've sort of addressed this before. So, again, I think it's a supply side issue. So regardless of the lower standard of living, regardless of people being laid off and a poor purchasing power at this time, the bottlenecks that have been created on that supply side, particularly by starting with the border closure late last year, and of course the restriction on interstate movements and all the restrictions that we have had, it creates a supply side bottleneck. For instance, transportation costs will certainly go up as a result of those restrictions and all of that. So all that is what essentially puts pressure on that headline number, particularly from that core inflation perspective. And for food inflation, really, right now we're essentially approaching, we're essentially in the lean season because, it's planting that's going on right now. So over the next couple of months, you're likely to see that, food inflation number even rise as core inflation continues to rise. So clearly, the trajectory for the headline number is, is upward from here.
Now, with the food inflation, is this a case of base effect setting in?
Well, so if you look at the year-on-year movement, really, it was just a base points movement. If you look at the food inflation, However, as a matter of fact, if you look at farm produce year on year, that came down, but processed foods essentially rose, and that rise in processed foods essentially offsets the decline that you saw in farm produce. So yeah, that's very very likely. But going forward, I think that there will be a bit more upward pressure on that food number, and by extension, the headline number.
Now, the reduced price of petrol was expected to create some kind of relief for core components. From your perspective or analysis, did you notice any impacts there?
Well, I mean, if you look at the core number year on year, that rose about 14 basis points. So clearly, we're not seeing that impact yet. Again, in spite of the reduction in those pump prices, the, if you will, reduction in economic activity will sort of put a cap or put a lead on that, if you will. But again, as the economy starts to open up even further, we are likely to see that pass through. We're also likely to see the rise in energy prices that is being slated for July to pass through and come through in inflation numbers, maybe sometime around August thereabout. So from all fronts, from all the various sub indices, we're likely to see this upward pressure on the headline number continue.
What are your thoughts on the introduction of core cost-reflective electricity tariffs, which will come into effect next month, and perhaps a possible effect on inflation numbers?
Well, so I mean, like I just mentioned, I think that was supposed to start sometime in April, but was put forward as a result of the whole COVID situation. So clearly, that is going to have a very direct pass through, particularly on the core inflation number. Again, I think these are some of the reforms that need to be carried out to ensure that the power sector remains viable. The jury is out as to whether the timing of that implementation is right. Again, question is, what time would be perfect for that to happen? But as regards inflation, that would essentially put some pressure on that core number, and by extension, the headline number would also rise.
So some analysts, of course, are already forecasting a further uptrend in inflation numbers. What is your own forecast?
Well, so, I mean, like I said, just as a way to sort of put all of this together, we're on the food front, we're seeing, pressure even continue. Like I said, we're heading into the lean season. There's planting going on now. So you're likely to see even further pressure on food inflation from farm produce, from processed foods, due to pass through from, exchange rates weakening. On the core front, you're also likely to see that continue, particularly with those VAT adjustments, also the electricity tariff as well. So from the major sub indices of the headline number, you're going to see upward pressure going forward. So clearly, at least over the near to medium term, for the better part of the remaining of this year, we're likely to see headline inflation continue to rise.
And how do you think these latest inflation figures will influence monetary policy decisions in the next meeting, which is next month?
Well, I think like we have seen over the last couple of meetings, I think the committee is actually much more focused on our external position, trying to create a balance or a sustainable situation, if you will, particularly on the currency front. Not to say that they are not concerned about the inflation number. They continue to watch that. But in terms of their decision, I think the anchoring comes more from that external position situation. However, I think that if inflation starts to tear away to maybe around 13 handle levels, we're likely to see maybe some reaction at this point. But again, I think the committee is much more focused on that exchange rate and how we can reflate the economy and have the economy pass through these difficult times, really.
All right, so as a portfolio manager, what's your advice to investors? How do they begin to perhaps rebalance their portfolios?
Well, I think it really has to do with what your objectives are as a portfolio manager. The truth of the matter is that the market has been quite volatile for some time now, and there have been opportunities, to take on risk and basically enhance return on your portfolio. For risk assets, particularly in Nigeria, it is important to try and pay attention to what's going on in the economy in general. It's also important to pay attention to what's happening specifically to certain sectors and see where you can pick up value. For the fixed income market, really, it is a case of the level of issuance or how much government needs to borrow versus the amount of liquidity that we're seeing. And so far, liquidity seems to be winning that war. So I think these are factors that portfolio managers want to look at and consider very strongly before you take whatever decision you are looking to take.
All right, thank you very much, Victor, for your time. Victor Louis is the head of
Thank you
portfolio
for having
management at Commercial Partners. We'll take a break, and when we come back, we look at the commodities market space with a particular focus on the cement industry. Just stay with us. Well, Dunkley Cement has started the exportation of clinker to neighboring African countries with a first export of 27,800 metric tons to Senegal. This move is expected to place Nigeria as one of the leading clinker exporters in the world. Well, joining me now to look at this move and, of course, other developments in the commodities market space is the CEO of financial derivatives company, Mr. Bismarck Rewane. Thank you very much, Mr. Rewane, for joining us on the show.
Yeah, good morning, Chimezie.
All right, just before we get into the cement industry, what are those economic issues that are really driving the commodities market at this time?
First of all, let's take a step back and look at what's happening to our growth. The Economic Sustainability Plan, Committee Plan, is suggesting that we could have a negative growth of minus 4.4% this year. If that comes out to be realistic, or if that comes out to be the truth, then we are going to have a situation where from 1.87 in Q1 to annualize it at minus 4, that means that we're going to have almost minus 5 and minus 6 in Q2 and in Q3 and Q4. Therefore, what does that mean? Now, but luckily, the oil price projection in that scenario was based on $28 a barrel. Today, we are seeing Brent at $40 a barrel. But Nigeria is having to comply with the production cuts. So having said that, in your last conversation with Commercial Partners, you talked about exchange rate, and the exchange rate passed through into inflation. I think it's important to understand that there's no other option we have but to unify the exchange rates and to eliminate the distortions in the markets due to multiple exchange rate practices. Our lenders are going to insist on that. Our donor partners are going to insist on that. And it's also good for our economy. So I'm just laying the context for what's going to happen in the commodity. Because when you have an exchange rate unification and an adjustment of that magnitude, then it will feed through into domestic prices, especially for those that have high import content. But also it makes your own exports more competitive because you just talked about clinker, and also we are going to be exporting cement, right? So I want you to see, one, the oil markets, two, the exchange rate adjustment, which is inevitable, even though in stages, and domestic price changes, and also our export competitiveness. When you now understand this, then you now come back to the cement industry as a whole.
So talking about this exchange rate and, of course, all this economic development, how are they playing out in the cement industry and, of course, the performance of the players there?
Let's go back. In Q4, where the economy grew about 2.25%, the cement industry actually grew by about 1.6%. So also in Q2. In other words, Q4 and Q1, the cement industry has been underperforming the GDP as a whole. But what is driving this? If you look at the growth rate in construction and the growth rate in the cement industry, they are almost identical. Well, but what we are seeing now is that the stimulus package and trying to revamp the economy means there's going to be a boost in construction. And once there's a boost in construction, then you will see a higher demand for cement locally and also a higher rate of growth of the industry and the companies in there. Now, why do I say this? Yesterday, the federal government announced the possible concessioning of 10 highways in Nigeria. If you notice, both along the Bagada Expressway and the Oworonshoki Apapa Oshodi Expressway, there's a substitution of bitumen for cement. If you look at in the inner city roads all over Lagos and everywhere, you are beginning to see interlocking blocks being used rather than bitumen and coal tar roads. So we are seeing the demand for cement is driven by construction industry, affordable housing, and the replacement of bitumen roads by concrete roads. I think that's a very, very important development. I think you should bear that in mind.
All right. Now, so Nigeria, up until recently, was one of the world's largest bulk importers of cement. Now, with Dangote Cement's exportation of clinker, does it mean we are now self-sufficient?
First and foremost, Nigeria is we are now self-sufficient. The total production in Nigeria is about almost 40 million tons. Dangote alone is producing 29 million tons. The second is Lafarge, which is about 10 million tons. And then you have BOA, who has about 8 million tons. So to all intents and purposes, Dangote is dominant. It has 70% of the industry. So because they invested substantially in Abajana, Ibeshe, and the other, the other locations, you will find that they were game changers. In other words, made Nigeria from being a net importer to becoming a net exporter. Dangote exports to at least 9 or 10 African countries. We're just starting off with Senegal with clinker. It has an export terminal, right? But it's also, the point is that the pandemic is going to reduce growth across Africa. So I think Africa is going to report about -2 to -3%. Nigeria is going to report maybe -4.4% according to the ESC plan. And therefore, whilst cement is growing and Dangote is growing, they would have to bear in mind that the cement industry is usually defensive and to a large extent cyclical. So what's going to happen in other markets, especially because we know the African Continental Free Trade Agreement is going to kick in sometime next year. So what the Dangotes of the world are going to be doing, the leading players, is that one, they will be producing, two, they'll be exporting, and three, they may have to significantly consider providing finance for for the countries that don't have that much money, have the less developed African countries. So in other words, if you are exporting to Senegal, you will export to Senegal, but you have to give Senegal some credit. And that's what I'm saying, that because Dangote has the balance sheet and has the stamina and the strength to be able to support this. I don't know about the others, but even the others also are doing very well.
Now, with this export, what will that mean for intra-regional trade within
Africa?
ECOWAS country particularly?
Well, if you look at ECOWAS countries, you take Nigeria, Ghana, and Ivory Coast. All the others are maybe Senegal to a large extent, but all the others are pretty much fringe players. A country like Gambia, Gambia's GDP is not as big as that of Ikeja, right? So while you look at the intra-African trade, or inter-African trade, as you may say, you will see that the likes of Dangote, that's what I'm saying, they have to not only produce, they have to financially support, and they have to actually send some technical support to those countries who are going to have to be migrating from normal concrete houses to affordable housing to interlocking blocks, right? To all that substitution towards concrete, right? And that's I think that's an important development for Dangote. The dominance, Dangote, for example, and BOA and Lafarge are not just Nigerian conglomerates. They are now becoming regional multinationals.
Okay, now looking at we have harsh operating environment, really, and Dangote Cement, of course, looking at the results, posted quite an impressive result in both 2019 financial year and, of course, the first quarter. What strategies do you think this company has continued to really put out there to maintain its share price? I
think the first thing is audacity to be able to invest well in advance. You're taking a long-term view. So you say, for example, the investment in Abajana and Ibeshe were done 4 or 5 years ago. when the exchange rate of the naira was like 169, right? Now they're reaping the benefits when the exchange rate is almost 400. So good, good capitalization, cost reduction, being strategic and having the boldness and the courage to invest ahead of time. So what you are seeing today is reaping of the benefits of past investments and the boldness to make those decisions at that time. What's going to happen in the future? Basically, they will continue to reap this because the replacement cost of that investment, which was maybe $10, $11 billion, today is about $25 billion. And that's why you find that people like Dangote, Bua, and Lafarge, they also now begin to rank in the Forbes list of the wealthiest people because that's what's happening. But having said that, we are noticing a reduction in the EBITDA. And the impact of the pandemic on the business this year is not going. We cannot write that off. That's significant. For example, in the first quarter, I think they did only 4 million tons or something like that. If you multiply that by 4, that comes to 60 million tons. But we are hoping that will pick up because they have all these road projects in Ogun State. They have road projects in Lagos where they have, in return for tax credits, they're building all of this. So there's a lot of upside. But I will caution that in the year 2020, just like the whole of the country and the whole of the world and industry, we are going to see some very, very weak numbers in 2020. But the economic value of the company and the investments are going to, you are going to see the benefits of this more in 2021 and thereafter.
All right, now what can you tell us about Dunkley Cement buyback? The details of the plan haven't been made, well thought out or clear to the market. Do you see a situation where the buyback exercise could really be broken down into?
No, usually when a company buys back its shares, it's because first of all, they have a lot of reserves, they have a lot of cash, and it's a good thing for the investors. So if you're buying back the shares, right, it means that the shares will appreciate in value, and those who are holding it are going to. So in anticipation of the buyback, what people do is to buy more, right? So, but when you look at, in the end, when you look at Dangote industry, the performance of Dangote Cement, one, you must understand that Nigeria, which is a major country, is a country whose growth is going to depend to a large extent on civil construction and works. We have 197,000 kilometers of roads in Nigeria, and these roads have to be maintained. I just talked about the concessioning of 10 roads. The roads, new roads have to be built. The roads were all designed for the whole path, which is from the north to the south. We don't have horizontal paths that go across from west to east across the country. All of those things have to be built. There are 774 local governments. There are 36 states plus one in the Federal Capital Territory. All of these governments have road projects. Even the private sector are looking for, have high demand for civil works. So I think that not just Dangote, but even Lafarge and Bua have a great one. But because Dangote is a dominant player and has invested significantly in capital, capital-intensive areas, including a power station, satellite towns, and all of that, the true value of the company is far in excess of what the financial values actually suggest at this point in time.
So what's the sector outlook, particularly with this COVID-19?
Well, the truth is that COVID-19, at worst, will be a 1 to 1.5 year phenomenon. After that, it's over. The stock price is a present value of future earnings. This company and these companies have invested significantly, right? And they begin to reap the benefits. As Nigeria adjusts its price in one, cost-reflective tariffs, which kicks in 2 weeks, and Nigeria adjusts its currency to unify the exchange rates, as Nigeria removes subsidies on petroleum products, you'll find that those companies that had invested way before now are going to be reaping the benefits. So the outlook, one, because construction is a stimulus that is going to bring this economy out of the recession that we are in already, and because construction is inextricably tied to cement, and there are only 3 players, and the 3 players, and one is dominant, which has about 70% of the market. Therefore, the outlook for cement, the outlook for construction, and the outlook for Dangote all look bright, but not in 2020, but more in 2021 and beyond.
All right, thank you very much for your time, Mr. Rwani. So Bismarck Rwani is the Chief Executive Officer of Financial Derivatives Company. All right, just before we go to the equities market, a look at the global oil market again as prices fell around 2% this morning as a spike in new coronavirus cases in China and the United States renewed fears that people would stay home, stalling a recovery in fuel demand even as lockdowns ease. U.S. West Texas Intermediate crude futures dropped 2.1% to $37.16 a barrel, adding to a loss of 42 cents on Wednesday. Brent crude futures fell 1.5% to $40.10 a barrel. The benchmark contract declined 25 cents on Wednesday. Worries about fuel demand rose after a surge in coronavirus cases led Beijing to cancel flights and shut schools, and several U.S. states, including Texas, Florida, and California, reported sharp increases in new cases. A rise in U.S. crude stockpiles to a record high for a second week in a row also weighed on sentiment, even though U.S. government data showed inventories of gasoline and distillate, which include diesel and heating oil, fell. Analysts say while prices dipped, they are likely to remain in the $35 to $40 band they have been trading in so far in June, with the Organization of the Petroleum Exporting Countries and its allies, a grouping called OPEC Plus, mostly sticking to promised supply cuts, U.S. shale producers holding back output, and fuel demand gradually improving. However, OPEC warned in a monthly report the market will remain in surplus in the second half of 2020, even as demand improves, as it now expects supply from outside the group to be about 300,000 barrels per day higher than earlier thought. And for a review of Wednesday's trading activities at the equities market, here is Temple. Temple, the index reversed into the green zone, all thanks to the consumer goods sector. Interestingly, industrial goods sector was unchanged.
Yeah, that's because investors are now looking for orders to come on board and see the opportunity they can now leverage to exit better still, do some kind of profit taking. But then thanks to Dangote, to Nestle actually, yesterday, Nestle was the major company that helped the market yesterday. Save for that, we would have been in a negative territory, because if we look at the sentiment or the market breadth yesterday, we saw some 24 losers in the market as opposed to just 10 gainers in the system. But Nestle gained some 10% and informed this rise that we saw in the market. We settled at 0.17% higher. Look at the activity level, volume of transactions. In spite of the contributions of Guarantee Trust Bank, we still had just 265 million. And if you look at the 30-day average of our transaction value yesterday, it settled around 2.7 billion naira. Yes, this is higher compared to what we did in the preceding trading session. Guarantee Trust Bank lost some 2% plus yesterday and informed all of what we had this port. If you look at the sectoral performance, the banking stocks were down. As I said earlier, consumer goods, Nestle was a very helpful stock yesterday. Cadbury and, of course, Flour Mill also contributed to the gain that we saw in this segment yesterday. But we have Philip Anegbe, who is a research analyst with Cardinal Stone Securities, joining us on phone now. Philip, thank you for joining us on the program this morning.
Yeah, thank you very much. Good morning.
Great. So we have seen serious decline in investors' confidence in the market in recent time. When are we likely to see some respite?
Well, the sentiments are likely going to be broadly mixed going forward. So what we expect is that some profit taking could continue, and the flight to relatively safer equity names.
Profit taking or sell down?
Yeah, so we expect to see the flight to relatively more defensive stocks, stocks with low leverage ratios, stocks with history of good profitability and low earnings volatility. So those stocks may be the choice of investors. But for the other stocks, you may see continued sell down and maybe a flight to relatively safe urban investment. And these are all going to be driven in part by concerns around oil. Oil is still very much a contentious matter for Nigeria because OPEC Plus Technical Committee met yesterday. There was no recommendation for further cuts beyond the July date. So that's still a concern. The demand outlook is still very weak. So all of that will inform more bearish sentiment and profit taking in some names. So defensive plays likely going to succeed.
Okay, Philip Anegbe, research analyst with Cardinal Stone Securities. Thank you for that sharp insight. We appreciate it. Chimeze, it's back to you.
We'll take a quick break, and then when we come back, we do an opening call to London. And for updates from the streets of London, here is Juliana Olainka. Good morning, Juliana. Well, with the Bank of England set to meet today, how are the markets taking position this morning as to what the outcome will be?
Good morning, Chimmy. Well, the FTSE opened lower this morning. I think it really took its cue from Asia. There are serious concerns, particularly in the West, about the second wave of infections. Beijing, they have been on a partial lockdown since yesterday, with flights being restricted coming in and out of the capital. And that's really starting to have a slow but crippling effect on a sell-off. And yes, as you said, the Bank of England Monetary Policy Committee are meeting today. I believe that traders have already kind of priced in their expectations. We're not expecting any movement in the already historic low interest rates, which currently sit at 0.1%, but we are expecting an expansion of quantitative easing. At the moment, I think the Bank of England have already purchased about £70 billion worth of government bonds. That's expected to increase by about £200 billion. So we'll get an update on that later today. And at the moment, the pound is trading lower against the US dollar by about 0.01%.
And while some experts say the coronavirus will speed up the decline in cash use in favor of digital payments, UK's money printer, De La Rue, believes countries may replace banknotes more frequently because of the virus crisis. And of course, they are planning to end banknote printing at its Gateshead plant, putting about 360 jobs at risk. Now, the firm also plans to raise about £100 million as part of a turnaround plan focused on shifting to plastic notes. How welcoming is this move for the government, and of course, what would be the implication of this?
Well, the implication could potentially be far-reaching. I believe this is where the world is definitely going to, particularly in the UK. A lot of our British viewers will know that most stores at the moment are only accepting cashless payments. So if you go into supermarkets, that's what you can expect. And I believe this is what De La Rue are putting all their money on, or at least they're hoping that this could perhaps be their way out of the trouble that they found themselves in over a couple of years. And it started a couple of years ago because they typically print British passports. But quite controversially, after the Brexit vote, they actually lost that contract with the British government, and it was given to a Franco-Dutch company. So that will be coming to an end at the end of this year, and they will be using that opportunity to shut down or at least minimise their Gateshead operation and start printing digital notes, plastic notes, as you say. Now, like I said, De La Rue, they have had a little bit of issues in the past. Last year, they announced 2 profit warnings, and they got in a little bit of trouble in South Sudan and Venezuela with the amount of money or the issues that they were having with governments. Those have ceased to be an issue for them anymore. But since the beginning of this year, they have lost about 61% in their share value. So today, they did announce that they're trying to raise £100 million in equity, and this is to transition into a company that print digital notes, and the shareholders seem to be happy with that as their shares rose by 5.1% in early trading.
And the UK's financial regulator, FCA, has fined Commerzbank about £38 million for money laundering failures, including an out-of-control system for checking clients. What will this mean for the German bank?
What it means is if, they've got to put their hands in their pocket, and they've had a slap on the wrist by the city watchdog, who've been really strong on tackling banks and making sure that they're controlling the money that's coming into their banks and knowing exactly who's putting it in and stopping money laundering. This is the second biggest fine that the city watchdog has given to a bank. The first and the largest was last year in Standard Chartered. They were fined over £100 million for a similar caution. Basically, what they have accused the bank of is over a period of 5 years not scrutinising the money that's been coming into their bank, not looking at the customers enough. As of 2017 March, there were about 1,700 customers of the bank that hadn't completed credit checks and satisfactory credit notes, and they had been warned about that. The FCA had told them time and time again over a period of 5 years that their regulation must be stronger. They didn't comply, and so they got this massive fine. The fine was actually of over £50 million, but the FCA said that because the bank were quick to comply and sort out all of the issues, they got a 30% discount, so the fine is over £37 million. But I believe that, the British financial industry are really using the FCA to cut down on money laundering, and this is an example of saying to the banks that you must play your part and you must have strong regulation to stop this money from flowing into their deposits.
Well, Juliana, we hope to get updates from the BOE meeting from you later in the day. Thank you. And back here on the debt and currency market, Temple is back on board.
Well, yes, Chimeze, thank you. But before we touch on the debt and currency market, let's look at what the unlisted securities market looked like as for yesterday. We had seen in the previous trading session the NSI, that's the NASD Securities Index, rising above the 700 psychological mark. But yesterday was time for some folks to take profit, and that brought back the NSI to 699.89, a depreciation of 0.72%. But if you look at of course, the market capitalization remains around 514 billion naira. But if you look at the volume of transactions, we had just 55,000. 5,000 of that came from CSCS in terms of volume. And of course, the remaining 50,000 came from WAMCO, which is the milk that you take. 2 of the deals happened on WAMCO, then 1 on CSCS, your market depository. Now, moving on to the debt side of the markets, look at the bond side of things. It was more order-driven yesterday. Again, a lot of investors and traders now traded cautiously ahead of the market auction, the bonds auction that took place in the markets yesterday. Basically, we saw order-driven around the 2036 paper and, of course, the 2037. Of course, we had a bit of interest around the 2049 paper as well. We'll be getting our analysts to speak to that, or a fixed income dealer to speak to that shortly. NTB side of the market, this side remained a little bit down again. Not so much is happening at the NTB end of things. But if you look at here, the open market operation maturities, we've been seeing lately some kind of improvements. Yesterday, some FPIs and, of course, some local banks sold down. They sold down yesterday. They had a couple of papers on offer. Look at the January 2021 and, of course, December 2020, which is at the shorter end of the curve. We had a bit of interest yesterday, a little bit of demand at the end of the day, but I understand that there was not so much of movement in the yields. But we have Caleb Alimi, who is a fixed income dealer with FSDH Merchant Bank, joining us via phone now. Caleb, please tell us quickly, what was the auction like yesterday? Okay, we'll try to reconnect with Caleb Alimi, who is with the FSDH Merchant Bank here. But yesterday, we understand from what we read, or what the feeds that we got, there was some kind of a 66% plus gain in terms of what was offered by the Debt Management Office yesterday. We understand that rates were slashed across the 2023 and 2035 and, of course, 2050 papers, because, again, there was so much of demand in the market. Caleb Alimi, FSDH Merchant Bank fixed income dealer, thank you for joining us on the program. Can you quickly bring us up to speed with the outcome of the bond market auction yesterday?
Thank you, Temple. Thank you, Temple. I hope you can hear me now.
Yes, I can hear you. Go ahead.
Okay, fantastic. So yesterday was actually a double auction, what you call a double auction. We had an auction for treasury bills and an auction for bonds as well. The NCB space, we saw yields decline, similarly in the bond space as well. So what I've heard is that there's been a lot of pent-up demand for both treasury bills and for bonds, and that put a lot of pressure. That put a lot of pressure on yield. The treasury bills auction was oversubscribed by almost 300%. The bond auction was oversubscribed by almost 400% as well. And then we did see yield fall across the board. We expect that that will continue given the fact that there's so much demand for these papers.
Any early rush you see at the secondary side of the markets today in terms of continuation of bids on all of these papers that some investors were not able to pick on yesterday? Okay, I understand that Caleb Alimi is no longer online. We lost that call now. But Caleb Alimi, thank you so much for your insights. Caleb Alimi is actually a fixed income dealer with FSDH Merchant Bank. But then we do hope for a profitable trading day at the secondary side of the market, which is made available to dealers and treasurers in the local banks and local space today. Chimeze,
absolutely. Let's just hope that the early morning rain today that caused a lot of traffic on the road will not dampen the spirits.
It could be turned into some blessings for us, you know.
Absolutely. All right. That's a wrap on the show for today. Thank you for watching. I'm Chimeze Obi Iwagu.